Yes, so a green mortgage is a fixed interest rate offer from many of the lenders in the market that is directly linked to the energy efficiency of the property you're trying to purchase. So they would range from A1 to B3, many of the offers, and the interest rate available is usually one of the most competitive in the market. So any new build or any properties that are A rated will have a lower interest rate offer available than properties that are further down the energy efficiency scale. So the mortgage process itself can vary in how long it can take, and you can get approval within 24 hours for certain lenders. The average will be maybe 7 to 10 business days for the majority of them.
As a general rule of thumb,
in terms of
when you're
closing
called
on
to
a mortgage,
snag, that's at a good stage to request your final valuation.
The average from when you go sale agreed will be anywhere from 8 to 10 weeks.
The property
because you're
doesn't have to
factoring
be
in
snagged
things
or
like your
snag complete
solicitors,
for you
your
to do your final
valuation
valuation.
report on the property.
So the final
your
valuation
reports if
can
they're
be done
needed as
when
well.
the property is
So
completed,
again, as we
i.e.
deal with all the
kitchens
lenders in the
fitted,
market, depending
bathroom
on
we're
the
in,
time sensitivity
tiling
of
done
your
in bathrooms,
application,
etc.
we can advise on which
as a general
lender
rule of
is
thumb,
best suited
when
to
you're
your
called
needs
to
in terms
snag,
of timeline,
that's at a
but
good
also
stage
interest rates that
to
are available.
request your final.
Yes, you absolutely can get a mortgage as a single applicant. The process and the procedure is pretty much the exact same for a joint application. So the documentations required are all the same, and the credit criteria is also the same as if you were a joint application. Yeah, so the best type of mortgage to go for is really dependent on a person's situation. So you can get a fixed rate mortgage from 1 year all the way up to 30 years, but then there's also variable rate mortgages and flex mortgages, which will fix for a 1 year period and then are reviewed after that. So what's best is really dependent on your needs. For some mortgages you can overpay even while within a fixed rate period. For other ones there's a little bit more restrictions around that. So the best advice I can give is to consult our broker team and to see which lender and which option best suits your needs. We deal and have agency with all the lenders in the market, so we can give you the advice on what best suits you. So yeah, switching is available on a mortgage in the Irish market. It can be quite easy to switch. The level of paperwork needed is a lot lighter than if you're a brand new applicant looking to buy a new home. From the lender perspective, somebody is already servicing an existing mortgage, so the level of credit underwriting can be a little bit lighter as well. You know, it's really good practice to review your mortgage every couple of years. So if you are currently in a fixed rate product and it's about to end in the next 6 months, for example, or if you are on a variable rate product right now, absolutely it's worth considering a switch from one provider to another. It can be a great way to save over the lifetime of the mortgage by reducing your interest by moving from one provider to the next. So it's definitely possible, but you do need to see what options are available. So by all means, get in contact with our broker team and we'll help you understand what options are available to you. How much an applicant can borrow is really dependent on your income level, your ability to repay the mortgage, and then the level of existing debt that you may or may not have on at the time of application. So all lenders will also look into any type of variable pay to factor that into the application. So what variable pay is would be if you get annual bonus, if you get overtime or allowances through your employment. So the circumstances for individuals when they're applying for a mortgage can be quite different. Again, the best advice is to actually speak to our broker team where we can figure out what's the maximum available to you based on your circumstances and based on those three main criteria. Standard documents that most lenders will look for are things like your most recent 3 month pay slips, salary certificate from your employer, the last 6 months of your current accounts, any current account or savings account that is active at the moment. If you are overseas for a time, they may look for things like a credit report from overseas, obviously your photo identification and all that as well. From our perspective, we provide you with a checklist of all the items that you'll need, so you'll be able to run down through what to send us in at the application phase. If you're self-employed, there's slightly different paperwork. Also, if it's a self-build mortgage, there's a little bit more documentation needed from engineers, costings, etc. as well. But we're there to help you along. The standard ones will be provided on the checklist to help you along the way. So for first-time buyers, generally the deposit required is 10%. It's also 10% nowadays for second-time buyers. The rules around that has changed in the last couple of years. However, there are circumstances depending on the type of property that you're looking at as a first-time buyer where the deposit may be higher. So for example, if you're looking at a one-bedroom apartment, there's certain lenders that will only lend 80% of the value of that, which means you would need to come up with the 20% deposit to purchase that apartment. The deposit itself can be made up of a combination of your savings, it could be a gift, or it could be any of the government schemes if they're available at the time, or a combination of all those things.